hear us now? Oh, I got some in my eye. Hey, everybody. Happy Friday. This is take number 2.
Can you guys hear us?
Can you guys hear us?
Can you hear us now?
Yes, no?
Anyone?
Maybe?
Anyone at all?
Anybody hear us?
Oh, I hear us.
Can you hear us?
Okay.
Yay!
There we are.
Okay.
Right.
I'm sharing this out right now.
I'm going to share again.
Share again. This is Finance Friday for those of you that missed
Take
it like
two.
the first time around
If you
because we
guys
were
were
having
here a minute ago, I hope you enjoyed the break.
technical difficulties. We're doing this a little early today. I hope you don't mind. Happy Friday. It's time to okay, good. It's time to actually get done early maybe. So that way you guys can feel like you're being productive.
Start
You're
the
on
weekend
Finance
off.
Friday, right?
I know you can't start the weekend off without seeing us. So
That's
now we're
right.
here.
Everybody's like, wait a minute, 3 o'clock, not 4? Anyway, okay, so Finance Friday. Obviously, you guys know the gist. If you've watched this before, this is the show where we give you all the information you need to grow and protect your money. We're going to transform your relationship with your money today by talking about all these investments, such as IPOs, like an IPO stands for initial public offering of Uber. We're talking about Lyft, who's been public for a few months. We'll talk about Beyond Meat, which was another big one.
Yep.
Luckin or Luckin Coffee.
Luckin, the coffee.
Luckin. Today, that went public today.
About it?
So how do you know if you should invest in these things? How do you know? Because I'm sure your neighbors are like talking about it and stuff. You know, everybody's like, oh, did you buy Uber? Or, you know, so we're going to cover that today. Follow us on Twitter at Nova Wealth Management. Management's abbreviated MGMT. Check us out on Instagram. We've been doing a lot of cool stuff on Instagram. And obviously check out our Facebook page. But share this out absolutely if you find value in it. So the first one, the biggest one, is probably just talking about like Uber, which happened last week.
Yeah, so Uber traded open on the market on Friday.
Mm-hmm.
It came out, it was a $45 offering that ended up opening at $42. So
actually fell.
Yeah, so it was actually opened lower than the offering price, which doesn't happen super often.
So I was getting calls like before it even opened. And by the way, if you've never really invested in stock before, an IPO is the first time that like the public can actually invest in. Why are you laughing?
Because Andy says it's hard to concentrate because we're early.
I know, I'm so sorry.
We're trying, we'll get through it together.
I know. But the first time that you as just a everyday investor, we call that the retail world, can actually go out and invest in Uber. Because otherwise when they're private, you really can't just go out and buy Uber shares and be involved. When you buy a stock, you're involved if the company does well and if they don't do so well. If you're in the private sector, you almost have to, you really can't invest in it. I mean, you have to become like part owner and things like that. So the stock market makes it really easy to invest in big companies. Anyway.
Yeah, but the problem sometimes is like Uber traded lower, which, you know, can be to some people be like, oh, well, that's a good thing because that means I got it less than the people that bought it privately. Right. But Uber still went down even further from that. And so one thing that we're talking about today is a little bit of the volatility that comes with these new stocks, the IPOs. They're coming into the market. Not a whole lot is known about them. Well, Uber, there's a lot known about it.
Well, like in the general sense that, yeah, I've Ubered before,
right,
but not a lot known about like the financials
right,
of the company, the health of the company, the investments of the company, the debt of the company. Yes, I mean, I got a call, like I told you, from my 89 or 90-year-old client the morning of Uber, and she's like, I just think I should have Uber. I think I should have it. She's so super cute because it's just the way that, you know, everybody's really driving, and it's like, that may be true, but you're not analyzing the competition. Look at Lyft. So Lyft went public. Was it 6 months ago already?
No, it was
4 months.
Oh gosh, was it?
I should have probably looked up the exact date. No. Okay, you're gonna have to look it up. But it hasn't been that long ago that Lyft, which is Uber's competition for those of you that might not know, went public several months ago. Ryan's going to look up the exact date, and it's really went down. And
it opened at it. So its offering was 72. It opened at 87. And is now trading at 54.
So what does that mean? That means like if you're involved in one of the firms that actually do, we call it the underwriting of the public offering, then you can get in at the public offering price before it actually goes on the market.
March 29th.
March 29th. Wow, I got to give you kudos to that. Wow, I said 6 months ago? Yeah. My concept of time is so off, man. So anyway, we've got some more comments coming in. So yeah, I know. Nice job. She's going to give you props. So it'll go, if you invest in it beforehand with one of the bigger firms that do the underwriting, you can get in at the offering price, which you said was 72 for Lyft.
Yeah.
And then the day it hits the market, it immediately spikes. And you and I, if we were to go out and buy it that day, we're going to pay 87. So we're already paying a premium. And there's a lot of hype that day. You know, they ring the bell usually at the stock exchange and all kinds of crazy trades are going on. And so it's kind of a crazy day. So if you invest on that day, usually there's big, crazy swings. And then now, as of today, Lyft is at 54. So if you would have bought it on that day at 87, it's now sitting worth at $54 per share.
Yeah.
So you would have lost money on that.
And another thing
so far,
to go back to Uber a little bit is that these companies that are coming in that are going public are a little bit more substantiated now than they were, and earlier on. And what I mean by it is their market their capital that they have as a company is already huge. And so, for example, Uber raised just under $8 billion in their IPO. So they're already their market cap is already in
big time.
Almost it's huge money. So the growth potential there is much. There's not as much room to just have double-digit growth when you're starting out at almost $8 billion.
Yeah, it kind of used to be. Well, when a company would go public, they're really still just getting they're getting going, or like any company, you might not have even heard of them before.
Right.
And today there's there's Luckin right there. Surge is an IPO debut. Yeah, Luckin Coffee is a huge Chinese coffee chain that wants to take over. They literally said that we want to take over Starbucks. They opened 2,300 stores in 2 years. So they're like, what we did in 2 years, companies have done in 15 or 20 years. They're soaring. They're going crazy. So the IPO today went out at $17 and is now at 20 by the end of the day today. Yeah. Well, I guess the market hasn't closed yet, but.
And Starbucks though has also hit a 52-week high today. So it's not, Starbucks isn't scared. So.
And they're not scared.
But they actually are comparing Luckin a little bit more to a Dunkin' Donuts because their price point.
Hey guys.
And there's a lot of different reasons. They're saying that it might be good for both companies having more coffee in China because Chinese people in China they drink more coffee or tea than coffee. And so, but coffee being addicting, the more stores, it can be better for everyone. They're saying there's room in the market for both companies. Do you know
that they drink more tea than coffee?
Yeah, the average person in China only drinks like 6 cups of coffee a year. Whereas over here, they drink like too much. I mean, you have like a spigot in
3
your house
cups a day.
Coffee. So
for sure.
So they drink tea over there, but not as much coffee. So, but everyone, coffee is super addicting, being that caffeine is the most addictive thing that there is.
A drug.
And so they are saying that once it kind of hits the market, there's plenty of room with the billions of,
Right.
So
how do you know if you invest in these things? So ultimately, if you're looking for a quick trade, like you're super familiar with stock, I can see the comments on my phone too. If you're super familiar with stock and you've had stock before and these price movements can be pretty crazy, or if you're a day trader and you get in there and you buy it early in the day with the intent of being out by the end of the day, that's kind of the definition of day trader. You buy in the morning, and by the end of the day, whether it's 1 hour or 6 hours, you plan on being out of that trade by the end of the day. If you're doing that, then this is obviously not a long-term investment. You're actually banking on these big swings. Mm-hmm. So would it be for you? I would say you definitely could look at these companies because you know your risk, you know the price swings, and you're okay with that. It's actually those of us that actually long-term investments, just so you know, after a stock goes public, 180 days or 6 months from the day that it goes public, all the executives can unload their shares. They have to wait 180 days. So usually on that mark, like there was big talk when Facebook went public. In 6 months, we're like, Zuckerberg's going to unload all his shares and cash in. And he didn't a ton, but they're allowed that day to cash in. So a lot of times the price can drop after 6 months because people are unloading the shares because that restriction has been lifted. So just be aware when you buy these IPOs or initial public offerings, or we call them like trendy investments, just be aware that the price may not really represent the actual worth of the company. in the first few months, maybe even first year.
Yeah, it takes a while to settle. I mean, Facebook, for an example,
It's more about demand.
It took a spike. It opened at around $38, and then fell to 18 and took almost 15 months to get back to its opening price.
Well, it opened at 38, ran up to like 44.
Yeah, 42.
42.
Yep.
And then dropped hard and fast over the next few months.
Yeah. And
obviously now it's up.
Yeah.
But
it's up big now, but it took time, and it was trading at 188 today. So long term, it's a good company. But if you're kind of sitting there going, oh, I can get in, thinking that the opening day is the ground floor, is not necessarily good advice if that's what you've been given.
Well, you looked at the last, how many IPOs?
Yes, the last 100 IPOs. Now this takes it back from the ones that opened today to back to, I guess, earlier this year, I think, or December of last year. So these companies are only 6 months into the public trading, but 45 of them are down and 55 are up. So you're really, it's almost a 50-50 to whether or not in 6 months to maybe less and maybe even a little bit more that you're getting to a profit. Now the ones that are up, some of them are up really, really big, and the ones that are down, some are really down, some are closer to the flat range. But yeah, thinking that that's going to be the lowest usually is actually, about 50% is not the case.
There you go.
So,
but like regular stock pricing, like when you go out to buy a stock, in general, for general investment purposes, you're trying to buy it because you think the company is going up from there. So when you buy the IPO on the day that it opens up, if you're buying it because you think it's going to go up from there long term, then that may be a good day to buy it. But don't buy it because you just think you're getting in at the ground level, because that is not always the case. Like Ryan just said, it's a 50-50. So for those of you just joining, we're just talking about trendy investments that have become available lately, such as Uber, Lyft, Beyond Meat. Oh, that's another one. So that one is up.
Yeah, so Beyond Meat is skyrocketing. It really took off.
It's been volatile.
Yeah, it has, but it's up pretty good. It's up 50 or 100% almost from its open trading. So it's offered at 25, opened at 46, and is now trading at 87 today.
Beyond Meat opened at 46.
Yeah. So you're still up almost 100%.
Beyond Meat is a company that's mostly vegan, I think. Vegan and vegetarian.
Yeah, it's all vegetarian. I don't know.
Vegan, I don't know.
I don't know if it's vegan or not.
But they're right up there. The next big hit is going to be the Impossible Burger that my clients have been telling me about.
Yeah.
They keep saying like Impossible Burger is going to go public soon because it's still a private company at this point. So that's one that we're watching out for. But Beyond Meat, definitely. So then you also have to ask yourself, am I comfortable with possibly losing this money? Because you're basing it on, like I said, the concept that's like, oh, everybody's going vegan. But you're not basing it on like, oh, the financials or the mergers that they've done,
and the fact
or the executive team. Really, you don't know how they're operating until you have all this public information, and they just went public.
Right, and you have multiple companies coming into the market that are in the same competition at the same time. Look at Lyft came out, and then that really, a lot of people are thinking that because of Lyft's failure, or to this point, Uber really took a hit. Now Uber also opened on a bad day. It just kind of was but the whole market was down when Uber opened, and so it kind of was fighting upstream.
Yeah.
But
from the get-go.
So there's a lot of things that can play into it, and that's why we've talked about it before. That short-term trading is really volatile. And it doesn't necessarily represent the price of that portion of the company that you're buying.
It's a vegetable stock for vegans.
Yeah.
Yeah, pretty much.
But Beyond Meat, and I think it's also going back to kind of there are differences between Beyond Meat, which isn't really a technology company, and something like Lyft and Uber, that they're having these venture capitalist firms where they're already, like we said, these large companies coming into the market. Right. So a lot of these things, you have to know the company. So I think the point is that they're trendy. These are a lot of really trendy companies.
And you're a lot of times at the IPO, you're basing it on the trend.
Right.
Like, oh, I think it's going to continue.
Yeah.
And that's a great idea. Just know the risk. All we're saying is Bitcoin is another one.
Yeah.
So last year, everybody knows, well, maybe not everybody, I shouldn't assume that, but Bitcoin is this cryptocurrency craze that everybody was talking about, and it went to 20,000 and then crashed. And at the beginning of this year, it was under $4,000 for one Bitcoin. So now today, we just thought it was at 7,100, which is down 10% today. It was 7,800 to open the day. So Bitcoin is this other cryptocurrency, super trendy thing that everybody's like, well, long term, I think it's going to be great. But everybody was hopping in at $18,000, $19,000, $20,000 per Bitcoin last year because they were like, it's never going to go down. It's just going to keep going and going and going. And it took a huge crash. So you just have to be super careful. You must be more long-term. You must be familiar with what you're buying. You must be okay with risking the money because these are risky companies at this point.
Yeah. And I think one thing too to think about is that if you're going to invest in something that's considered a trendy company, are you hitting it on the trend? Or, how much more trend does it have? So, we talked about it before of knowing, when to get into a stock. You have to guess twice if you're going to be trading in and out of it. And so, if it's trendy, usually just like everything else, trends usually fade after a while. They may come back again later on, but they fade. And so where on that peak and are you on that trend?
Well, and you have to ask yourself, are they innovative? Yeah. So like if the concept of Uber really kind of fails because of a new transport system being put in. Maybe Elon Musk, invests in the underground subway, fast train, whatever.
Or for example, something that hit today is Amazon is now going to start a food delivery service, which is obviously going to compete with Uber Eats, and Amazon usually wins those battles.
Right. So you have to ask yourself, can Uber adjust? Are they innovative? Is the concept that they have good for longer term? You have to ask yourself those things because it might not be. It might be. I'm trying to think of the one. Let me look at your list. Oh yeah, Snapchat.
Yeah. Snap and Twitter.
They're not doing well, right?
Fitbit even.
Oh my gosh, Fitbit. That might be the one I'm thinking of. I'm totally choking right now.
So Fitbit, everyone was wearing the Fitbits for a while, and so it opened at $30.
Pinterest. You don't even have Pinterest on here.
Yeah, I don't have Pinterest on there.
I can pull up Pinterest.
But yeah, so Fitbit opened at $30 and is now trading at $4.95.
Ooh, that's not good, guys.
Yeah, and Snapchat opened at right around 22, I think, and is now trading at 11. So, so it's.
Yeah, that's tough.
Yeah.
Yeah, let me look at Pinterest. Oh my gosh, it was all the way up to $34 and it's at $26.90. And I mean, that thing, it won't give me the whole chart for all of it. You guys can pull up these charts on your phone, by the way. It's went straight down since the day it IPO'd. So, I mean, that's another one that, are they trendy or can they be innovative? And, you can ask yourself that, but then you can also get somebody that's nerdy and analyzes financials like us, and to try to see if once they've been public for a while and they publish their financials, by the way, we mean income statement, cash flow, balance sheet, which is like assets and the debt that they have. Once they publish all that stuff for a few quarters, and we can see how the executive team is managing and we can see how they're innovating and what they're investing in, then we can make a better call on where we think the stock is going. But on the IPO day, I feel like your guess is as good as mine almost.
Yeah.
Sometimes I don't feel like I have any more information. On regular equities, we know how to analyze.
Right.
But on IPOs, I feel like it's kind of
it's
just
really
a coin
just
flip.
it's kind of a crapshoot. You can look at what the company has done as far as innovation, things like that.
Right.
But it really is going forward, you don't really know until you start to see what their revenues are, how they're making their money, what their profits, things like that, and how it's being run. And you don't really get to see that until it's on the market for a little while.
For sure. So if you guys have any questions or there's any investments that you were wondering about, keep in mind what we were talking about today is investments that you can go out and just buy like on the open market. It's not like a startup company that you have to put in a substantial amount of money to be like part owner. That's a different day. Startups are like, like I had Stephanie Gomez from Stabilize Steph, shout out to her because I love her. But that's like a startup company that you are investing capital in the company and it's private. It's not available to everybody. Right. You have to put in substantial amount of capital for either a debt investment, like you're lending them money and they're paying you an interest rate, or you're getting a piece of equity. So that's different. These investments are just available. You could go out and buy one share of, Lyft today for
Yeah.
55 bucks?
Yeah,
Something like that.
54.
Yeah.
And I think going back to something, Amy, you say a lot is, what hurts worse? That's what you're going to have to ask yourself when,
always.
because sure, if you could kick yourself, hindsight 2020, you could look back and go, oh my gosh,
why didn't I buy it?
It's up 150%.
Yeah.
Well, sure, maybe you'll get in it a little bit late, but if it's a solid company, it's going to continue to grow, then it's worth it still investing in a year from now.
People look back at Amazon.
Yeah.
Like they're like, why didn't I buy Amazon? It's like, but you have to understand.
It was a book company.
Yes. I was just going to say that. Like it was books.
Yeah.
And it was like kind of like eBay type thing.
Yeah.
And then people were like, once they started getting more items, well, how are they going to manufacture all these different items? How can they possibly have all these different items? It was not this like hot trendy thing when it really first came out. So you have to remember that hindsight, looking back, is 2020, and you have to do what hurts worse. Like if I didn't invest and it took off, or if I do invest and I lose everything, what hurts worse? So we'll leave you guys with that. If you have any questions, go to our website,
Careful, of course.
NovaWealthManagement.com, and you can find us there. And obviously you can put in the comments any other trendy investments. We're happy to analyze and just put in the comments, kind of what we think. Nothing that we say is recommendation. I should have said that right in the beginning. Darn it.
Reverse. We'll start over.
No way. It's not a recommendation because we don't know your personal situations, but we're trying to give you a good gist of how to analyze and make the best decision for yourself. All right, guys. Have an awesome weekend, and we will see you next week. Thanks.
Have a great weekend, everyone.
Bye.